Canadian Tire, an absolute staple of Canadian retail, just put up some really fantastic quarterly numbers. But then, on the very same day, a Morningstar analyst report came out and kind of dropped a bombshell, asking some serious questions about the company's long-term health. So what's the deal here? Is this a huge success story, or is it a warning sign in disguise? Okay, let's get into it. So here's the plan. We'll start with that impressive quarter and why the analyst is raising a red flag. Then we'll look at just how big this Canadian giant really is and explore this idea of it being a castle with no moat. After that, we'll see who they're up against, and finally, we'll get to the analyst's final verdict on the stock. All right, so first up, let's look at the news that got everybody talking. A really, really strong quarter for the company. On the surface, things look great. The company reported a huge 10.7% jump in its fourth quarter retail revenue. A number like that? Well, it suggests the business is absolutely firing on all cylinders. But, that's not the whole story. Because at the exact same time we get this line from analyst Christopher Inton, he basically says he's skeptical that these good times can actually last. And that is the real story here. Fantastic numbers today, but some really big questions about tomorrow. Now, to really get why this analyst's skepticism is such a big deal, you have to appreciate just how massive Canadian Tire is. We're not just talking about another store. This company is a core part of the Canadian landscape. Their reach is just enormous. Think about it. Over 1,400 locations, and that includes banners you definitely know, like Marks and Sport Chek. They are so woven into the country that over 90% of all Canadians live just a 15-minute drive from one of their stores. Throw in a loyalty program with almost 12 million people on it, and you're looking at a true retail behemoth. So if the company is that massive, what's the problem? Well, according to the analyst, it all comes down to one key argument. Canadian Tire is like this giant, impressive castle, but it's missing a really crucial defense. And that defense is something called an economic moat. The analogy is perfect. Think of a deep, wide moat around a castle that keeps all the invaders out. In business, it's some kind of lasting advantage. Maybe it's unique tech or a huge cost advantage that protects a company's profits from competitors, not just for a year, but for the long haul. And this is the kicker. According to the Morningstar analyst, Canadian Tire's economic moat rating is none, zero, zilch. Even though it's been a household name for 100 years, the report argues it has no durable, long-term competitive advantage to protect itself. So why no moat? Well, the analyst points to a few key things. First, the stuff they sell is pretty general. It's easily copied by competitors. They don't really have a big cost advantage over their giant rivals. And that loyalty program, it's free, so there's nothing really stopping you from shopping somewhere else tomorrow. And yeah, the brand is iconic for sure, but the analyst believes that's just not enough on its own to lock in profits for years and years. And this whole lack of a moat problem becomes even more critical when you look at who Canadian Tire is actually competing against. They're not just fighting other local shops, they are going up against global titans. Just look at this comparison. It is staggering. Canadian Tire's market cap is under 10 billion Canadian dollars. Walmart's over 1 trillion US dollars. And then look at those moat ratings. None for Canadian Tire versus wide for Walmart. The analyst sees one as a basically undefended castle and the other as this massive, impenetrable fortress. And the pressure doesn't just stop with Walmart. The report makes a point of calling out the threats from other wide moat giants like Costco, with its super powerful membership model. And of course, the unstoppable e-commerce force that is Amazon. Okay, so what we have here is this clash between strong short-term results and some really serious long-term fears. So let's bring it all together and look at the analyst's bottom line. What does all of this mean for the stock? So what's the final call? This chart from the report pretty much tells the whole story. It shows the stock's price against what the analyst thinks it's worth. The blue areas are when it was undervalued, and orange means overvalued. And right when this report came out, the price was sitting squarely in that overvalued orange zone. Let's put some hard numbers on that. At the time, the market price was hovering around $185 a share, but the analyst's fair value estimate, what they believe the stock is actually worth based on its long-term future, is only $172. That's a pretty significant gap. And that really brings us to the core takeaway. The analyst's whole argument is that the market is getting way too excited about the good news happening right now. that awesome 10.7% growth, while totally underestimating the serious long-term threats from these powerful wide-moat competitors. So it all comes down to this one question. Canadian Tire is, without a doubt, a Canadian icon. But based on this analysis, is its beloved status causing the market to completely overlook some fundamental risks to its business? It's a classic Wall Street story, a great quarter versus a really tough long-term forecast.